Hi guys, today I'm going to discuss a very basic topic, but I've seen a lot of students doing this basic wrong. So I felt a need to make a video on this. Guys, I'm the commerce specialist. Welcome to my channel where you'll find content covering various academic qualifications and professional certification, including life-changing business ideas and hacks. Guys, today we're going to talk about shares. What are shares? What is the double entry to record when a company sells shares, and some basic concept relating to shares. So first of all, you need to understand when we say share is an ownership right. So let me give you an example. So if you want to buy a business, what do? You buy all the assets of the business. Okay, so we all understand that there is an accounting equation: assets equal liabilities plus capital. So from all the assets, when you minus the liabilities, we call it net assets, and your net assets is equal to the capital. In a sole trader, who provides money? The sole trader, the owner himself. In partnership, who provides the initial investment? The partners. But in a public limited company, who provides the money to start the business, the capital? The shareholders. Shareholders are the investors. So if you and I want to invest in a company, what we will do? We will buy the company's share. A share looks like this. It's a certificate, it's a piece of paper. Over here, let's say we have $10 written. This is known as the par value. Par value means the face value of the share. It is also known as the nominal value. Here the name of the company is, so on and so forth, maybe a logo. What if a company has 1,000 shares? So if you want to be 100% owner of the company, you buy all those 1,000 shares, and for each share you pay $10 if the shares are sold at par value, at face value. What we're going to discuss is the double entry when a company issues means sells shares. So if a company sells shares, how do they record and what are the possibilities? So let's have a look. We are assuming the par value, the face value of share is $10. So issued here means sold. So if a company sold 5,000 shares at par, means they sold a $10 share for $10 only. So if a company sells 5,000 shares at par, that means the face value of the share is $10 and the company is selling them at $10. So what is the double entry? Generally, if it says cash, you can debit cash, but normally shares are sold through bank, but we are assuming cash. So you always debit cash with the number of shares being sold, multiply by how much it is sold for. It's sold at par, that means par is 10, so into 10. So cash will be debited with 50,000, and you always credit share capital. Share capital is always credited with the number of shares into its par value being 10. So you have 50,000. Alternate name of share capital is also common stock. So in different books, somewhere they call it share capital, sometimes they call it common stock. It's the same thing. So remember, cash will be debited by the number of shares multiplied by the price you're selling it for. That's much the company is receiving. Share capital is always credited by the number of shares multiplied by the par value. Let's look at the other situation here. Now you are issued means you sold, the company sold 8,000 shares at $14 each. Let me remind you, the par value is $10. A $10 share the company is selling for 14. It is a possibility. Companies can sell the face value of the share, the amount written on the face of the share, the face value, the par value could be 10. But the company has a very good reputation in the market. There is a lot of demand for the shares. They may sell at a higher price. And this is what exactly is happening here. So if the company is selling 8,000 shares at the rate of 12, the entry would be, you always debit cash with the number of shares being sold, multiply by the amount what you are charging, the selling price of the share is 14. This will give you 112,000. Please remember, share capital is always credited. Share capital is always credited by what amount? The number of shares. Forget how much it is sold for. Share capital will always be credited with the par value. So number of shares into the par value, which is 10. You'll get 80,000 here. And now we know that the par value of share was $10. It has been sold for 14. So par value was 10, it was sold for 14. How much we got over and above the par value? So a $10 share has been sold for 14. So the extra amount being charged is known as share premium. So number of shares, share premium is always credited with the number of shares multiplied by the amount above par. Par was 10, you sold it for 14. So the amount charged for premium over and above par value is 4. This will give you 32,000. And when you add, you'll get 112. So I repeat, when you're selling shares at a premium, always debit cash by the number of shares into the selling price. Credit share capital, number of shares into par value. Credit share premium, number of shares into the premium per share. In this example, premium per share is $4. Why? Because the face value is 10 and you're selling for 14, so the premium is $4. Finally here, we are selling 9,000 shares. So cash will obviously be debited. We are selling 9,000 shares. We are selling for how much? $8. Although the face value is 10, but we are selling for 8. So cash will always be debited with the selling price. Number of shares into the selling price is 8. So this will give you 72,000. Credit share capital, the golden rule. Share capital is always credited with the number of shares multiplied by par value, please. Now we understand that the par value is 10, but we are selling it for 8. There is a possibility the company is in dire need of money. So a share which has $10 written on the face of it, they're selling it at a discount, which is $8. So if the par value is 10 and you're selling it for 8, you're selling it at a discount, and a discount is always debited. Discount on shares. 9,000 shares are there. $10 is the face value. You're selling it for 8. So discount per share is $2. So this will give you 18. You add them, it will come to the same. So guys, I hope you have understood the double entry when we are talking about selling shares at par, selling shares at premium, and selling shares at a discount. The other two possibility could be, although there are many possibilities, but this is just a basic video for you to understand the mechanics behind recording sale of shares. So now comes the bonus issue. Bonus issue or bonus shares are when companies sell shares to their shareholders but does not charge any money. So if you look at this, whether shares were sold at par, premium or discount, in all these cases company was getting some cash. It was sold again cash. Maybe a $10 share was sold for $10, a $10 share was sold for 14, a $10 share was sold for 9 or 8. But in all these situations, company was getting cash. Sometimes company sells their shares but does not get any money in return. We call it bonus shares. Shares given free of cost to the existing shareholders. Most of the times you don't get a straightforward question that the company sold 10,000 bonus shares. So that's pretty simple. Sometimes they write like this. Company issued been sold 1 for 10 bonus shares. Now what does this mean? 1 for 10. This means if I am the company, I am selling shares to you. If you have 10 shares already, for every 10 shares you will get 1 new share. This means 1 new share for every 10 shares already issued, already held by the existing shareholder. So the very first task for us is to calculate how many bonus shares we are issuing in total. For that you need to know how many shares are outstanding. Outstanding means already issued. So if you look at this, company sold 5,000 shares initially, then 8, and then 9. So 9 and 8 is 17, 17 and 5 is 22,000. Which means already the company has issued 22,000 shares. In other words, 22,000 shares are already outstanding. So the very first thing is we need to know the number of bonus shares the company is issuing. So how you calculate that? You make a fraction. When it says 1 for 10, so you keep 1 in the numerator, 10 in the denominator, multiply by the shares sold already. You sold 5,000 shares. Can you see this? 5,000, 8,000 and 9,000. So when you add all of them, it comes to 22,000. And when you solve this, you will get 2,200 shares. In other words, what if you are the only shareholder, you have all the 22,000 shares, all the shares were sold to you. So you already have 22,000 shares and the company is giving you 1 new shares for every 10. So 1 upon 10 into 22,000 means you will get a total of 2,200 bonus shares and company is not charging you any amount. So what is the double entry then? Please remember, normally we debit cash and we credit share capital. So I'm not going to debit cash because the company is not receiving any cash. Debit I'm leaving blank, but I'm crediting share capital. Whenever the company is issuing shares, you're getting money or you're not getting money, that's not important. But the company is issuing share, you credit share capital. If nothing is said, we have 2,200 shares. Multiply by, if nothing is said, that means it's par value. So that comes to 22,000. So if the company is issuing shares, whether for cash or without cash, free of cost, we have to credit share capital. What will be debited? Please remember, when we are recording bonus shares, the very first thing we look at is, do we have share premium? If yes, we have share premium account. How much is the amount available here? 32,000. How much do we need for bonus shares? 22. So we have enough balance available in the share premium account. So we will debit share premium by 22,000. Please remember, this is the very first reserve. Share premium is one of the reserve which can be used to issue bonus shares. So from now onwards, if you're issuing bonus shares, what you're going to do? You're going to credit share capital. And obviously you have to find the number of shares. Credit share capital, debit share premium. What if the share capital, the amount to issue bonus shares is 22,000, but in share premium, if we have only 20,000, not 32. So we will debit share premium with 20. Another 2,000 we will take from retained earning if there is any balance in that. First, you consume your share premium balance for issuing bonus shares. If there is not enough money, then comes retained earnings. Guys, I hope you have understood the bonus shares part. Now we're coming to right issue. What is the meaning of right? Right basically is a preference. So let me give you an example. In the past, I wanted to sell my car. So once I spoke to my neighbor that I'm interested in selling my car. So he told me, whenever you want to sell your car, when you have made your mind, please let me know because I want to buy your car. One fine day, I decided that I want to sell the car. And I had an offer from somebody and I sold that car. I forgot altogether what my neighbor told me. And after some time, when he saw that I've bought a new car and he's asking me, where is your old car? I said, I've sold. He said, I already told you that I'm interested. You never told me. You never gave me the preference. So generally, we prefer our neighbors over outsiders. The same concept applies in companies. What if I'm a company and you are the shareholder, existing shareholder? You have already purchased some shares of my company and my company wants to sell more shares. We are interested in money. So if we sell to outsiders, we will get the money. If I sell to you, you will also pay me. So company normally prefers to ask our existing shareholders, do you want to buy additional shares? If not, we will sell it to anybody. So that is known as right. The existing shareholders have the right to buy shares if the company wishes to sell additional shares. So at the moment, here we are talking about right issues. Please understand, right issue may or may not be made at par value. Right issues can be at par value. It could be on a premium. It could be on a discount. It depends. So the argument is not when we are issuing right issue shares, the argument is not when we are having a right issue whether it is at what price. It could be at any price. What is more important is to understand how the number of right shares are calculated. Let's have a look here. So it says a company made a 2-for-5 right issue for $12 each. Now here first we need to understand how many shares are we issuing, are we selling. And again here 2 for every 5 means for every share sold already. So let's recalculate. Initially the company sold 5,000 shares, then 8, then 9, that makes 22,000. Then we made a bonus issue of 2,200. 22,000 plus 2,200 is 24,200. So the number of right shares company is issuing is basically 2 upon 5, means 2 new shares for every 5 shares multiplied by the shares already held. So 22 and 2,400 is 24,200. So it gives us 9,680 right shares. Now how to record? It's pretty simple. You're getting cash, you're getting cash, you're selling 9,680 shares, and each share you're selling it for $12. So 9,680 into $12 will give you 116,160. You credit share capital with par value 9680 multiplied by 10, you get 96,800. And you credit share premium because obviously selling for 12, the par value is 10. So 9680 into 2. $2 is the premium per share. So guys, I hope you have understood this, the double entry for recording shares at par, premium and discount. What are bonus shares? How to calculate the number of bonus shares? What is the double entry? What are right shares? How to calculate right shares? What is the double entry? If you have any questions relating to all these, please feel free to leave a comment. I'll reply to you as usual. If you're not yet subscribed to my channel, please subscribe to my channel. That's the minimum you can do to show me that you value my work and support my channel. If you like this video, guys, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time.